Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about an underappreciated tax planning opportunity, underappreciated section of the tax code, which is Section 1202, and has to do with tax-free capital gains on the stock of your small business. I say that it's underappreciated because I think there's a lot of opportunities for people to issue stock in this manner in a way that if you issue it at one price and then sell it down the road at another price, that capital gain can be totally tax-free at the federal level. But as always, there are some stipulations, there are some rules, and it's something that you ought to know about. I am admittedly not an expert in this area of the tax code, but if you think it might be a good option for you, I would suggest that you reach out to your tax professional and, as our disclaimer will state here shortly, perhaps your lawyer, because it could wind up to be very beneficial to one or more of our listeners. That being said, I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the podcast, I would like to use the time to cover a somewhat obscure section. Obscure might not be the right word, but underutilized is probably a better way to describe it. Underutilized section of the tax code that has to do with investments in small businesses. And for our listeners, as you might recall, this is a podcast to help business owners optimize income and pay less in tax and invest prudently and do the best they can with their resources. This is a potentially great way to pay a little bit less in tax on your business transactions. Meaning, when if you are buying or selling a business, or perhaps selling your own, this is a really, really good thing to at least consider. Not every company is going to qualify for it, but it can offer up to $10 million in tax-free capital gains if it's structured properly. And what I'm getting at is Section 1202 of the Internal Revenue Code, or qualified small business companies. It's QSBs, qualified small business stock, I should say. So the way that this works is if you have a C corporation that checks a number of boxes, then if you sell the shares of that C corporation at a gain, you could qualify for tax-free capital gains. And usually the way that this plays out is, let's say that you have a business that you started with $100,000, 10 years ago. And so your basis in the shares of the company or in the assets of the company, same difference in this circumstance, is $100,000. And then you go to sell the company to someone else. And let's say that it's a stock sale. So you're getting ready to retire. You've built the thing up. You agree to sell the company for $1.1 million. You have a $1 million long-term capital gain on your hands. And at the federal level, that's going to be taxed at 20%. Because of that amount of income coming in. You're also going to be assessed the 3.8% net investment income tax for a total of 23.8% tax on that transaction, or $238,000 going to the IRS. What I'm suggesting is that there's a way to structure this so that you pay zero on that. Now, to be totally clear, I'm not an expert in this section of the tax code. I've been around a couple of these transactions and I'm aware of it, but don't take my description today as the letter of the law, because it's not. What I'll do today is describe what this is, describe when it might or might not apply to you, and talk about a couple strategies where it makes sense to entertain this. Because I think for a lot of businesses out there, a lot of small businesses out there, which is exactly who we talk to on the show, this can really make a lot of sense to consider when you're structuring the organization of your company. But if you get to that point, this sounds interesting, you think it could be a good fit, please go talk to an expert. We have the disclaimers at the beginning of the show, of course, but beyond that, just go talk to somebody that does this all the time, because that portion of it is not me. I'm aware of it. It comes up a little bit in our practice, but it's a cool enough section of the code and has enough potential impact that I wanted to devote today's episode to covering it. So let's start with a framework of when this does and doesn't apply. This only applies to domestic C corporations who have assets on the balance sheet of $50 million or less. There are a couple caveats to this. Assets meaning original cost before being depreciated. So if your organization owns, or if your C corporation owns a building that's been depreciated over the years, it was originally worth $70 million. You've depreciated it all the way down to $20 million over the last 25 years, or 20 years or whatever. Well, that doesn't count, unfortunately. It's original cost, and that threshold has to be below $50 million, both before and immediately following any stock issuance. And that part's important, because you might say, well, if $50 million in assets, we have our building and we have our equipment and we have this great cool new thing that we do, and we have intellectual property around that, our assets are only $25 million. So let's organize as a C corporation to do this, and then take in $500 million of equity funds, issue stock and raise capital, take in $500 million to fuel our growth, that is, and it'll all be qualified as a small, qualified small business stock for the benefit of those shareholders. It doesn't work like that. You got to be below $50 million in assets before and after raising capital, meaning that the size of your balance sheet has to be below that amount. So unfortunately, it's a little bit more complex than that. But $50 million is a pretty hefty balance sheet for all the small businesses that we typically work with in our firm. So that's the threshold. It has to be a C corporation. If you have an S corporation, you can, of course, transition that with the help of some attorneys if this is interesting to you. In addition, this doesn't work for companies in all industries. It doesn't work for service businesses. And what I mean by that is, if you recall the qualified business income deduction, man, I'm really nerding out on tax stuff today. I hope this isn't too boring. The way the deduction is calculated depends on whether or not you're a specialized service business. So architecture, financial planning, my business is a specialized service business, law, accounting, those are all specialized service businesses that have that deduction, which is unrelated to what we're talking about today, haircut in a couple of different ways. For qualified small business stock, you cannot be in those service industries and have qualifying stock. You have to be in basically technology, retail, wholesale, or manufacturing. Pretty much anything else doesn't count. Farming doesn't count. Financial, personal services, hospitality, none of those industries count at all. And whereas historically people get pretty creative with this stuff. They would say, well, I have a law firm. Why don't I just open up a t-shirt shop down the street under the same umbrella? We'll name it, John Smith Legal T-shirts or something like that. It'll be owned by, or it'll be a part of our law firm, but that will check the box for being a retail operation. It doesn't work like that. At least 80% of your business has to come from the qualifying organization or qualifying business, I should say. So that loophole has been closed, unfortunately. So the genesis of this whole thing was in 1993. There was some bill passed. Not that I can't remember. I simply don't know the name of the bill that was passed that incorporated this into the tax code and made this a potential option for people. And initially, if you acquired stock in a qualifying small business after that piece of legislation in August of 93, then you got to exclude 50% of your capital gains up to $10 million. And then there have been subsequent revisions. In 2009, there was a revision to this, and if you acquired stock after February 17th of 2009, you get to exclude 75% of it. And then they revised it again, September 27th of 2010. So if you if you acquired your qualified small business stock after 2010, then you get to exclude 100% of it. So if you have stock in a qualifying small business that you've held for a long time, it's got to be a C corporation, remember, you've held it for a long time, the portion of the gains that could be excluded depend on that acquisition date. And the minimum is 50%. If it's more recent than that, if your acquisition date is more recent than that, you can exclude up to all of it. Now, the investor, the holder of the shares, cannot be another corporation. It can be a partnership where the partners are individuals, but it cannot be a corporation. You also have to acquire the stock on original issue. And what that means is you have to get it directly from the company that issues it. You can't buy it from another individual in a secondary market type transaction. Whether it's in a market or direct with somebody else, doesn't matter. You have to get it directly from the company. And so what that means is you have to either purchase the stock directly from the company. You give cash to the company as an investment. The company gives you shares of the qualifying stock, or it could be property too, right? You could pay for it with, I don't know, your car or something like that, as long as it's a commensurate value, or you get the stock as payment for services. And so for that reason, it's a pretty nice employee retention tool because you can issue restricted stock units and other forms of employee compensation if you set this up properly. Now, there's a downside to that, which I'll get into here in a few minutes. But basically, you can't just organize as a C corporation and then hand out a bunch of stock to all your buddies for tax-free capital gains. It has to be commensurate with. It has to be an arm's length transaction. You get the company is valued by a valuation expert. The shares are valued by that expert, so you assess what each share is worth, and then those shares are either given in an exchange for property or cash. So if you have 100 shares of your C corporation that exist, and those shares are all worth, let's call it $50 each, you've got $5,000 worth of shares. You could sell, one share to somebody else, but they have to give you $50 in cash or property to make up for it. You can't just give it. Or you can give an employee a bonus of $50 via shares of those restricted stock units. And they could qualify for this tax-free capital gain that I'm trying very hard to describe and maybe not doing such a good job today. So those are the requirements. It's a really useful thing for angel investors, for companies that are trying to attract capital and grow, for companies that are trying to retain their employees or maybe attract employees. It can be structured in a way that's really useful there. But if you hold the shares, again, you have to pay for them with cash or property or receive them in exchange for services rendered. You hold the shares for 5 years or longer. You sell them. That's when the tax-free capital gains treatment kicks in. If you sell them before 5 years, you can defer the gains so if you own one share, it's worth $50, you sell it back to the company or to somebody else, doesn't really matter. For $75, you have a $25 capital gain on your hands you have to pay tax on. That $25 can be deferred if you reinvest it within 60 days in another qualifying small business. And again, that reinvestment cannot be shares purchased from another individual. It has to be direct from the source, direct from another company. So there's this opportunity here for growing businesses, and venture capital people know this quite well. A lot of the venture capital funds out there don't really swim in this pond because of the size limitations. For a lot of the bigger funds, they have so much money in their pool of investments that they only fund companies that are a lot bigger than 50 million. That's not all venture capital funds, I should say. But in that space, this is a pretty common thing people are aware of. So those are the qualifications, right? If you have a company, you're a C corporation with $50 million or less of assets, you can potentially make this work. There is another limitation, and this is the final one. I know I'm throwing a lot of rules and framework at everybody today, but there's an aggregate limit of $10 million of tax-free capital gains per company. So if you're an entrepreneur and you have 3 different companies and all of those have qualifying small business stock, you hold that stock for 5 years, you sell it, you can get $10 million tax-free per company at the federal level, total of 30. So you can do this as many times as you want, but it's a per corporation limit of 10. And there's an annual limit of 10 times the basis of the stock sold in that year. So back to our example, you hold one share of this qualifying stock, it's worth $50. Your tax-free exclusion limit per year is the $50 it was worth when you got it times 10, or $500. So even though, one share might not be worth $10 million to fill up that entire tax-free, that entire exclusion amount, you're limited on an annual basis to 10x the original investment, which means that if you're in the situation and you have a substantial gain in qualifying small business stock, what you want to do is spread it out in a way to where you can reap these tax-free rewards for as long as you possibly can. So there's the framework. There's a lot of rules stuff. It's probably a lot of nonsense that you may be half listening to me by now, if you're still listening at all. But there are great use cases for this. Now, before you say, well, hey, my small business is doing pretty good. Maybe I reorganize to a C corporation. I hold all the stock myself, and then I can just sell the stock tax-free on down the road. There is a drawback. What I've described so far is the good news. You can structure it as in a way to exclude up to $10 million. The bad news is that if you're issuing stock to yourself or employees as compensation, that compensation is subject to FICA and FUTA and income tax withholdings because it's considered taxable income, right? If you want to give all your employees a $10,000 bonus via shares, or restricted stock units, RSUs, shares in the company that are potentially subject to this great tax treatment, that $10,000 bonus through shares is still taxable income to them. That's the downside. So if you have let's go through this. If you have a company that's worth $1 million and you're thinking about selling in the next couple of years, and your basis is, let's say, $100,000 because you started the business a long time ago, you put a little bit of money into it, you've grown it, now you have some employees, and maybe you're getting close to the point where you want to sell. If you're not a C Corp yet, you need to be a C Corp to qualify for this. And so if you're an LLC or an S Corporation, that means you need to issue shares of this, or you need to reincorporate as a C Corporation. So if you're not in receipt of the shares, you're in receipt of just the equity in the LLC or all the membership units in the LLC. You have to issue shares as a corporation, and those shares need to be valued. The corporation itself needs to be valued to know what the shares are worth. And if you give yourself, 95% of the equity or $950,000 worth of shares, that means that you're going to have $950,000 worth of taxable income, which is kind of a challenge. You have to withhold for that and do all this other stuff. So again, I'm not the expert here. If this is interesting to you, go talk to the attorney who is, go talk to the accountant who is, because there may be a way around this, a way to reorganize your organization, reorganize your existing S corporation or LLC in a way that doesn't trigger income to you for the value of the shares. Nevertheless, if you pay this to employees, you're going to have to withhold for that. It's taxable income to them. And that's, a nice benefit to give people, but you need to communicate that too, of course. So if you're in the position where you think the value of your stock's going to grow, that can still work. If you own, the business 100% outright, there may be a way to reorganize without having that income triggered that I'm unaware of. That's very possible. But if you expect to grow the value of your entity over the next few years or for an indefinite period, all the future growth in the value of that business could be tax-free if you handle it right. So that's where the opportunity is. If you're nearing your exit and have grown the value of your business already, it's probably not available to you, I would say. If you're expecting a lot of future growth, this might be something to consider. Transitioning to a C corporation has other implications. The way cash and distributions are handled needs to be handled a little bit more delicately. As you probably know, with a C corporation, if you have profit left over at the end of the year, the corporation is the entity that pays tax on that. And then if you take the cash out and pay yourself, then you, the individual, pays tax on that as a dividend as well, or as W-2 compensation, depending on how you structure it. So there are other ramifications of reorganizing as a C corporation. But if you're expecting a lot of future growth in the equity of your company, then yeah, it can sometimes make a lot of sense. So here are the main use cases that I see. There are two of them. Yes, this could be useful for your own exit if you're thinking a long ways down the road. But if you're growing your organization through equity investments, through angel investing, this is something you definitely want to consider, because an angel investor is going to want as much for their investment as possible. And if that investment can potentially be tax-free, it means they're going to want less of the equity from you. And it's just a really attractive thing that's kind of a no-brainer to set up if your trajectory is to take cash in from outside investors in exchange for shares of the company. Secondarily, employee retention, it makes a lot of sense. And again, you want to tread lightly here, because any grant of a stock from the corporation, even if it qualifies for this favorable tax treatment, is considered compensation. It has to go through payroll. You have to withhold, again, for Social Security, FICA, FUTA, income, estate, and federal income taxes. And then they have to pay tax on that as the shares vest. But the beauty of it is, yeah, the shares can vest over time. You can structure that to keep people around if that's what you want to do. You can have the shares vest all at once. You can spread it out over, I think it's as much as 4 years is the rule there. So you've got some flexibility, and it's a really nice retention tool that big mega corporations just use all the time. So those are the main considerations. State laws vary. I'm in California. California does not conform to the federal treatment of this exclusion. So even if you have $10 million of tax-free capital gains at the federal level, unfortunately, you still need to pay tax in the state of California on it. But it's still, the juice is still worth the squeeze if you have that kind of organization that's growing at that clip, and you want to shield future gains from taxation. So those are the main use cases. I would suggest you ask your accountant, ask your lawyer about it if it's halfway interesting. In general, when you get into this kind of stuff, meaning you're issuing RSUs to employees that vest over time, or you're taking in equity capital from investors, your oversight, your bookkeeping, your financial upkeep and transactions and just organizational complexity goes up in a very big way. So for those of you out there that just want to keep things simple, this is probably not the right move. But if your organization is growing and you plan to continue growing in size and scope and complexity, then this could potentially be a good fit. It kind of goes hand in hand with the stuff that you add to a business as a suite of tools to retain employees. You have company benefits, you have your compensation and career track packages and all that stuff. As companies grow, you might add a retirement plan, you might add health coverage, you might add other fringe benefits like gym memberships, short-term, long-term disability, a legal plan, those kinds of things. Well, you can add equity compensation through this to the suite as well. But I'll tell you that adding a health plan is one heck of a lot easier and a heck of a lot more straightforward than reorganizing to qualify as to qualify your small business stock for this kind of tax treatment, and then issuing RSUs, because now all of a sudden you've got to get the company valued periodically. The headache grows by quite a bit. So that's it for today. I think the takeaway here is that if you've got a growing organization, this is a really cool way, a really cool feature to exclude future capital gains from taxation. I hope that I didn't nerd out on tax stuff too much today. If you're someone who makes angel investments, then this is something that you probably want to ask about, is at least understand the parameters of what qualifies for the exclusion and what doesn't, so that you can use that when you're evaluating your own angel investments, which is a pretty cool thing to do. We've done a little bit of that here and have clients who do that, and it's an interesting way to go about growing capital over time. All right, that's it for today. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.